What's up, folks? It's Eric from Option Edge, and today I want to talk about a specific strategy where there's no upside risk, and the only downside risk is getting a great stock at a discount. Let's get into this video. What's up, everyone? It's Eric from Option Edge, and today I want to talk about the Jade Lizard strategy, what it is, how to do it, and how to make money off it, more importantly. Let's get into it. Let's start with just the basics. So the Jade Lizard consists of an out-of-the-money put. It can be a cash secured put, or if you're using a different margin brokerage, you can use a regular put. I prefer to use a cash secured put because for me, it takes a little less risk out of the play if I'm doing it with a stock I like. Also consists of a bearish out of the money call credit spread. So you're taking a bullish put, naked put, and then combining it with an out of the money call credit spread. Bias is neutral to bullish. You make money if the stock doesn't move much. You have no risk to the upside, basically. How do we set this up? First, step one is we're going to sell a cash secured put. I like to do these in stocks that I wouldn't mind owning. I wouldn't mind owning 100 shares of Apple. I wouldn't mind owning 100 shares of Tesla, of Amazon, of Microsoft. They're a little pricey. You want to do these with stocks that are like below 100, maybe like $80 or less. So what you have to look out for is you want to aim for a credit of about $1, okay? You might be able to get more of a credit in certain underlyings. Step number two is to sell a call credit spread. You're going to want to do only a 1 to 2 strike wide out of the money call credit spread, and you're going to want to aim for the credit to be about 30% of the short put credit. So if you sold your short put for $1, you want to aim for about like 30 cents on the call credit spread. And here's the most important part about this strategy. The credit from the short put must be larger than the width of the strikes of the call credit spread. If you do that, there will be no upside risk. If you don't do that, there will be, okay? So it's important that you understand that. Let's just go to the next slide here. And so here is the diagram of the Jade Lizard. I guess you could sort of see why it's like a, I don't know, a little reptile with a tail, I guess. I don't know if you guys see that. But so I selected a 90 put to sell for about $1 credit. The call credit spread ends up being, here it says 25 cents, but it's really like 33 cents, and you'll see that in the next slide. But yeah, that's how we set it up. You realize that there's no upside risk here. As you can see, we're green to infinity and beyond. So we discussed the upside risk, which there is none in a Jade Lizard, but there is a downside risk. And the risk is if the stock drops below your short put strike, so in this case, the $90 strike, that's your short put strike. If the stock drops below that, there's a couple things you can do. One, you could roll that put out into time for a larger credit, which is going to reduce your risk on the trade. Or you could be put those 100 shares at a lower price for $1.25, $1.33, whatever the credit is you receive. You're going to get a discount. You're going to receive a credit for taking on that risk. So that's why I think it's important to try this strategy with stocks you wouldn't mind holding for the long term. You know, Amazon is a blue chip stock that doesn't seem like it's going to be going anywhere anytime soon. So you can sort of see that as a very low risk play. And then the other thing you can do, let's say you are put those shares, you could also run a covered call strategy above those shares and receive even more credit. And hopefully by doing that, you can break even sooner and easier. And let me show you an example of why the credit from your put must be greater than the width of your call credit spread strikes. So let's go to our call credit spread, which is here. We have us buying the 106, selling the 105. So let us increase the spread width to just $1, okay? So a dollar extra. So now we have the 104, I'm going to select the 107, we have the 105, 107. So now you can see we do have upside risk. You can see if we go above that short strike, we do make some money until we get to the 106.57. Then after that, we are going to be losing money. So this is why it's important to keep your strikes with less than the width of the credit from the put. Let's look at a 3 strike wide spread. You can see a spread that's 3 strikes wide to the upside is going to have even a greater loss. Let's look at, I don't know, 110. And now we can see we are incurring a larger loss, okay? So those are the basics of the Jade Lizard option strategy. So I hope you guys enjoyed this video. Like and subscribe, comment, ask me anything. I'll be around. Peace.